Hey guys, a video on traditional markets. This is something that was requested by Rife in the group, and I think is worth making a quick video on because a lot more people are getting interested in traditional markets at the moment, whether that be because of the volatility around the S&P or just because they're kind of getting a little bit sick of crypto and constantly getting dumped on. That's kind of the two reasons that people are interested right now in traditional markets. And so Rife has basically said, can you kind of give an overview about what traditional markets are, the basics around the pros and cons versus crypto, the types of instrument used, requirements to trade them, or anything that may be seen as a quick start guide for somebody who knows nothing about them. So I thought I'd very quickly cover off what my thought process is around traditional pairs and how to trade them, where to trade them, and some of the things to keep in mind as a bit of a quick start guide. Essentially, what you have in traditional markets, you basically have four main trading regions. Okay, you have FX, your Forex pairs, you have commodities, which are things like your gold and your silver. You've then got your indices, which are like your S&P 500, your Dow Jones, your FTSE 100, and FX, commodities, indices, and what the fuck is my fourth? How am I forgetting the fourth? Commodities, indices, fucking equities. Jesus Christ, my favorite. And equities. Okay, so equities are like your typical stock market, right? Your Apples, your Amazons, your Disneys, your Netflix. So they're your four key regions. Okay. Now within those, you've got varying degrees of volatility. You've got varying market hours, and you've got various places to trade each of them. So we'll kind of go through them one by one. So first of all, as a broad coverage to traditional markets, the reason that I enjoy traditional markets so much are right now in crypto, whenever I get on stream and the group, the kind of approach in the group so far this last week has basically been the following. Okay, I'll hop onto BTC. We'll look at BTC and we'll say, okay, BTC looks absolutely terrible here. Okay, 40% decrease in a week. It looks awful. Now, I can take that analysis on BTC and apply it to every single one of the alts in this list. Every single market here, there's nothing that looks different to BTC. And if BTC looks like this, there's no reason for me to trade any other market because I just can do one piece of analysis on BTC and they all look the same. Traditional markets are the complete opposite of that. Traditional markets have some assets that are bullish, some that are bearish, some that are ranging. There is so much difference between each of the markets and the assets within there. There are, of course, correlations in traditional markets still, but nothing that dominates the entire space like BTC does. So from a traditional markets perspective, it's just really great to trade traditional markets because there's so much opportunity out there. It never just feels like, okay, well, BTC looks like shit and it's ranging, so therefore everything else that I could possibly trade is also doing the same thing. And that basically sums up crypto. Traditional markets, it's like, okay, gold looks like shit, but actually there's some really nice plays on equities that I want to look at today. Right? And there's some really nice plays on equities that my system lines up perfectly to trade. So traditional market is all about range of options. There are so many options available to you. Everybody talks about cryptos like there's all these markets. There's always a different alt to play, right? But if they all look like shit, they all look like shit. Traditional markets are far different to that. So let's start off with FX. So FX, we've got basically two categories. We've got majors and what are considered exotics. So majors, there are our major pairs, Euro USD, Cable, that's GBP and USD. We have a majors list. These are the highest volume traded, and they are the primary FX pairs that you will see. Outside of that, you have exotics, and something we discussed on stream today from Zizo was the Brazilian real versus the US dollar, which would be considered an exotic pair. Okay, it doesn't have a huge amount of trading volume. It's basically like an altcoin of the FX world. Okay. And in the nicest possible way to Brazil, it's basically a shitcoin. So we have these exotic pairs as well. Primarily, your focus will always be on the traditional pairs. Okay, the majors. That's kind of where the nicest moves are focused around, is the majors. What you have to keep in mind with majors is that typically, okay, given that the last 2 weeks are an exception because of what's been happening, the volatility is relatively low. So if we take a look at, for example, from the 29th of, that's a poor period because it's Christmas. So let's take it from here, the 17th of January here to the 23rd of January. So a week of trading, we moved a grand total of 0.3% in FX. Right. So in this market, this is a 0.3% range over a week. Okay. So let's take it over to BTC. All right, and let's just look at this week here. So from the 28th of January, basically the same time period, right? We've got at least a 4% range. And this was a particularly slow time for us. This was particularly grindy, it felt like, in BTC. So FX pairs are far slower. There's far less volatility when it comes down to higher time frames and your intraday movements. Okay, there's far less volatility here, right? 0.3%. Now, there's two things that means for FX pairs. Number one is that 1 minute charts become viable as options, right? 1 minute charts are great scalping opportunities for FX pairs. And secondly, it means that you probably have to utilize leverage. Because of the relatively small movements of FX pairs, it means that you can manage your position well when you use full leverage. And remember that most traditional exchanges usually offer you around 500x on FX pairs. So a huge amount of leverage. So it means you can really bump up your position sizes, okay, to get value from these 0.3% ranges. FX pairs are just great markets to trade. Okay, they're really nice markets. They tend to trend very well. They work well within certain systems, RSI based, trend based, divergence based. They tend to just work nicely as full markets. They are obviously impacted by news events. Okay, so there is a level of fundamental analysis that fits into all traditional markets, not just our major pairings. Okay, so that's FX. There are majors, there are exotics. You need to use leverage to take advantage of these. They typically do not have a huge amount of volatility, and therefore the leverage will help you with that situation. Okay, next up, let's talk commodities. Commodities, your golds, your silvers, your wheats, your corns, your oils, natural gases, they're all your commodities. These tend to be slightly more volatile. So all of these tend to have slightly more volatility to them. So if we take a look at gold, for example, obviously, again, ignoring the last 2 weeks, let's take the range down here. Right, so again, we've got a sort of 3.6% range that formed here, and they're typically just more aggressive trades. Okay, so for me, trading commodities, I tend to have more aggressive trades with commodities in terms of scalping. So I'm a big fan of trading commodities. I really like metals. Okay, that's primarily what you'll focus on. You'll focus on gold, silver, copper, platinum, palladium, and great markets to get into. Typically, exchanges offer less leverage to trade commodities. You're usually looking at around 10x leverage for most common exchanges for trading commodities. Really nice options. Historically, gold, metals have been seen as a safe haven asset for those of you. Some of you may already be aware of that fact. So whenever typically we saw things like the S&P 500 doing particularly poorly, gold responds very well. Obviously, times have changed a little in the current climate. On commodities, again, your position sizing is important because some of these are expensive assets. So you need a relatively decent amount of capital in order to work with them. But again, because of the volatility here, even if you're getting leverage in order to be able to trade one gold, okay, you can benefit on, moves like this, moves like we saw here. Okay, it's a $71 move in gold, right? So even if you took out one gold, that's $71 if you catch the move. And with the leverage, you can probably get yourself a couple of gold in your position. Commodities largely available everywhere. US is going to have more difficulty in securing leverage on their exchange of choice, but highly recommend taking a look at gold, silver, copper, platinum, and palladium as your starters for your commodity list. Natural gas is another great one, and so is oil. Both good additions actually to that list. Okay, next up, and I don't really need to transition because I don't really want to go too much through indices. So we'll stay here. We'll just take a look at the S&P. Okay, so for our indices, this is our country grouping for their indexes. So we're looking at the S&P 500, we're looking at the Dow, looking at the FTSE 100. So we're looking at each country's major index for trade. Again, these tend to come at around the same leverage that the commodities markets operate at. They are equally volatile. Okay, they probably share the same level of volatility with precious metals and with some of the commodities markets. So take the S&P here, kind of a 1.3% range up here, and then obviously trending very well given the bull market structure that it was in. But largely the same for indices that we see on gold. The only difference that we have on indices is that a lot of these indices are quite heavily valued. Okay, so when the FTSE was trading at around 7,000, the S&P obviously at 3,300, the Dow at 27,000. So we see these are quite high capital assets to be trading. And again, keeping in mind that the price movements here are quite strong, and if you're using leverage, it will very quickly spiral into your account. But indices, largely the same thought process and the same thinking as precious metals and commodities, which then takes us on to stocks. So stocks are tradable. Well, they're best to be traded if you're based in the US. You will have the biggest range of options available to you if you're in the US and you want to trade stocks. The reason being is you'll have access to options, but you will not usually have access to leverage. If you're based in Europe or the UK, it's highly unlikely you have access to options, but you will have access to leverage. Okay, so you'll be able to leverage trade some of these stocks, whereas you will not be able to play options in the same way the US can. When we're looking at stocks, one of the major differences, and I should have covered this on the other markets, FX pairs are open 24 hours a day, 5 days a week. Okay, the same with indices, the same with commodities. They're open 24 hours a day, 5 days a week, Monday to Friday. Obviously, 2 a.m. is when Asia comes online on Sunday night. So that's when we see the markets basically come to life in a traditional sense. US equities obviously operate on purely stock opening times, which is Wall Street opening times. So we're talking about 9 a.m. Eastern, okay? And then everything gets shut up at 4 p.m. Eastern. So you get around 7 hours of trading a day on stocks. Obviously the difference that you have there, and you'll notice this on any stock chart that you pull up, is you see all these gaps. because after hours trading occurs and price can shift rapidly from one day to the next. This can be quite a scary thing for anybody that hasn't traded markets like this. Okay, so you see here, like Apple opens 1.3% higher than it closed for this day. Okay, 1.3% higher. And then you have days like this, right, where you close the day up here and you open the day 2% down. Or 2% up if you're in a short position. So traditional markets, because they have this fixed opening and close time, okay, and aftermarkets trading exists, you will have times where you will gap down. So whenever you refer to gaps, this is what we're referring to when the market is closed and it opens at a different price point because the fulfilled orders have now all been processed, and this is the new price for this asset when it opens. The way to try and manage this is, if you want to day trade stocks, then go for it, right? Really good option to day trade stocks. Just make sure you close out before the end of the day. Because unless you've got a great position, you run the risk of something changing overnight and affecting your position. And there's nothing worse, right? We always think that crypto is bad because, we can have 10% price swings. But imagine having those price swings where you can't do anything about your position for another 12 hours. And that's what happens in these markets. So you need to make sure you protect yourself if you're trading stocks. If you're based in Europe or the UK and you want to trade these, then just use any traditional broker like CMC Markets and you'll be able to access these US equities markets. You can also use something super simple like Trading 212 or eToro, and that will get you access to US equities. If you are based in the US, you should be using Thinkorswim as an option choice for this. You will have access to options, and the trading platform is fantastic on there. They've got a really great inbuilt trading platform. Works really well. It's got Renko. It's got everything you're going to need in there. So that's what I'd be recommending to use for equities markets. Be careful trading equities. Again, they're volatile. They respond obviously very heavily to any company news, any financial news. Fundamental analysis is pretty key for these. And you'll notice down the bottom we have E and D, and that will be displayed on all your trading view charts for equities. Okay, E, and then if we had an asset like, let's say, Disney, we're going to throw up some Ds on there as well. So what these are your earnings. So this is when earnings are released, and you'll see that pretty much every single one of these E's responds to a period of heavy volatility for the asset, because this is when the earnings report for the company is released. D is the dividends. So this is the dividends payout for stockholders. So they are represented, and you'll see those represented on your trading view charts whenever you have US equities loaded up. So we can see here on Apple, their next earnings is due to be released on the 5th of May. Okay, and that will be for the period ending March 2020. And massive spoiler alert, this is going to look like shit. So I think that's basically it. That kind of covers the 4 areas of traditional markets that I wanted to run through for this video. If there's any questions on traditional markets, then just give me a shout. I would love to see more people interested in traditional markets. In terms of signing off, I think that if you are getting a bit disillusioned with crypto and you are feeling as though it's just the same old shit over and over again, and there's no real opportunity for you because right now everything looks like ass, then consider looking at traditional markets. Consider expanding out your watch list, and even if you just go away and chart some traditional assets, then go and do that and take a look at some of these FX pairs, some of the precious metals, some of the US stocks, some of the indices. And just look for the different opportunities. There's a whole other world of financial markets out there that you can go and take a look at. All right. Any questions? Give me a shout.